Hello and welcome to Policy Watch, your weekly date with the biggest business stories, their context, their relevance and their impact. I'm Surabhi Upadhyay. Well, joining us on the show today to talk about a lot of interesting developments that have taken place is Himangshu Watts of the Economic Times. Himangshu, it's always great to have you in the studios. We promise to keep you interested with three rather interesting stories of the week. So let's start with the first of them. Key economic data released this week paints a worrisome picture for India's economic turnaround. Data shows that both retail and wholesale prices have reversed their declining trend. Inflation is rising once again, and this rise is primarily due to an increase in the price of fruits and vegetables. Now, let's look at the numbers. Consumer inflation rose to 8.31% in March, as against 8.03% in February. Wholesale prices also are mirroring this trend, with the wholesale price index climbing to a three-month high of 5.7% in March. Food prices seem to be the key reason behind the spiral up. Take a look at the intricate details. Vegetable prices increased 16.8% in March, as against 14.04% in February. Prices of fruits rose 17%, as against nearly 16% rise in the previous month. Retail prices of protein-rich items such as eggs, fish and meat, along with cereals, showed some moderation in March, but not enough to cushion the overall impact. Prices of milk and milk products increased about 11% in March, compared to about 10.4% in the previous months. So what is going on? Himangshu, before we talk about inflation, I'd also like to draw your attention to a string of other data points that have been released, and they're all rather wobbly. We saw the trade deficit numbers for March. We also saw the IIP numbers, Index of Industrial Production, and now inflation. What's going on?
Well, it doesn't look very good. What it all gets together and points to primarily is that the economic recovery is going to take longer than what many people thought. There's a lot of view that we'll get a strong government in May and, then things will start unrolling. They probably would start unrolling, but with this kind of a base, it would take time. And what is depressing about some of the data, like factory output, etc., is that it is falling on a fairly low base. It's not that a year ago there was a sudden huge spurt, and compared to that, it's looking, there's no statistical aberration or anything. It is just going down, so which does not look good at all.
And it has been contracting over the last couple of months. We were hoping this time that contraction will at least stop. Maybe we'll get a stable trend, but that doesn't seem to be happening.
That has not happened. So, and particularly, during the election campaign, one does expect some kind of a demand generation for certain goods and services, including, oil consumption, etc. So, even in that circumstance, if it is there's no indication of high consumption. So that's not very good at all.
Most of the growth estimates for this year are somewhere between 5% to about 5.5, 5.7. The most optimistic might touch 6. But I think the number of people in the 6% camp is in minority. I mean, that's not a very large number in terms of overall growth.
Yeah, in the current fiscal year, in fact, very few people would expect 6 upwards. Yeah. The general expectation, I would say a near consensus among economists and analysts, is that you would expect some good pickup in the next financial year, not the current financial year, because this financial year would require a lot of repair. A lot of companies who are under stress and under a lot of trouble, they would need a year and a half to set their own house in order, to mend their own balance sheets before they think of new investment, new growth. So the current fiscal year, which has just started, would be perhaps better than the one that ended in March.
Which was sub 5%. It's hard to forget.
So it's not correct to expect good growth immediately.
In that context, now we're looking at inflation rising, and more reports, many of them in the Economic Times, tell us that perhaps the El Nino phenomena could be around the corner. We're already talking about the impact of these unseasonal winter rains on the crop. So is inflation, particularly food inflation, going to become a key issue?
Well, that's one to watch out for. Already inflation has risen. And, in terms of vegetable prices which have gone up, this is a kind of a transition period from the winter vegetables to what you have in summer. So what is being planted and cropped just now, it's pretty vulnerable to weather. And the weather has been fairly unusual the last few weeks. There have been a series of this weather phenomenon called western disturbance, which causes unusual rain. Then eastern India has been very dry. So vegetable prices are rising. And coming to your question on El Nino, see, the first thing we need to be very clear is that El Nino has often been linked with a weak rainfall or a drought year, but not always. So one does not rule out the possibility that things would be okay. But yes, in the last few cases of El Nino, India has suffered badly, particularly in 2009 when you had a pretty devastating drought. And that's what led to a pretty sustained and stubborn burst of food inflation. I remember December of that year, I think food inflation was 20%.
Correct.
And India never really recovered from that.
That's the point I was coming to, Himanshu, that the prices that we're talking about, this price rise, the figures that I was reading out, it's all in double digits, depending on which fruit, which vegetable you're picking up. It's anywhere between 10% to as much as 18, 19%. And this is not on a very low base. It's not as if prices last year or last season were unreasonably low. Therefore, the hike seems a lot this year. It's already on a pretty substantial base, isn't it?
Yeah. See, one of the things that's happening is as many Indians move out of poverty or from abject poverty to a relatively acceptable poverty or into the lower rungs of the middle class, the first thing they demand is more of food, more of maybe a bit of fried stuff, a different quality of food. So the food demand increases a lot, whereas in terms of supply, there have not been any game-changing differences, like you had the Green Revolution in the 60s or that kind of a productivity increase India is lacking.
Or a complete overhaul of the back-end storage change, etc. We haven't seen those kind of reforms.
So if you see, 2002 also there was a drought and a pretty bad drought and food prices went up, but in 4 or 5 months again, it was business as usual again. If you look at the 2009 drought, its impact was for years. Plus, you have this issue of so many middlemen. People start anticipating, okay, there's going to be bad crop, they'll start hoarding, prices go up. So, it's a bit sad that the farmer also does not really gain from these high prices. And the demand-supply situation is pretty tight.
For the country as a whole, for the economy, and particularly the euphoria that we've seen in the markets that are too preoccupied looking at, some kind of a windfall election victory, is there reason to start worrying now because of all the data points that we've discussed?
It's reason to have caution in your optimism, I would say, because the last couple of years in terms of the second half of the current government, there have been problems in implementation, various policies. The general investment demand, consumer demand has suffered. Companies are not ready to set up projects. So one would expect, when there's a new government, there is a honeymoon period, there would be some policies, there would be investments. But yes, all these data points, once again, are a reminder that don't think, there's a button you'll press in the second half of May and,
back 10% growth straight away with low inflation.
That's far away.
We'll take a very quick break on that note. But when we come back, we look at some very interesting statistics that have been put out by a branch of the Planning Commission as far as employment growth in rural India goes. Back in a moment. Welcome back here with Policy Watch. Now, as election season rolls on, we look at some interesting economic statistics that have been put out by the Planning Commission's Institute of Applied Manpower Research. According to a paper put out by this institute, 37 million people left the agriculture workforce between 2004 and 5 and the 2011-12 period. They found work in non-agricultural activities, a sign that the economy is perhaps moving towards the maturity which is associated with development. Jobs were growing both in the construction and in the services sector. Another trend that has been highlighted by this institute is that both non-agriculture and agriculture wages have risen since 2005, and this has led to a decline in the absolute number of poor in India. Rising rural prosperity seems to be a reality that shows up in consumption trends across the country as well today. Himanshu, so drawing your attention towards this Planning Commission paper, it seems to be indicating that not everything is as depressing as what one thinks, or one has seen the coverage in the media as well, in terms of the last 10 years. Now, without getting political about this, yes, we know it was the UPA government in rule, but that's what some of these trends or these numbers seem to be indicating, that jobs were growing, and they were in fact growing in the non-agriculture sector, which is supposedly a good sign. It shows that our economy is maturing. How would you interpret this?
See, to some extent, it is continuing a trend which has been there for a few decades now. As manufacturing and services expand, the share of agriculture in GDP has been declining. It was, close to 30% some time ago, in the 90s sometime, and it came down to 15, 14, it's falling. Then the agriculture sector's ability to create jobs is not very strong. If you look at Indian agriculture, I think 80% of the farms and fields are pretty small holdings, which get divided in every generation, which means they do not have the economy of scale in terms of getting irrigation and the best seeds, mechanization. There have been some innovation that you have some micro kind of tractors which these guys can afford, but the basic farm economics is not sound. The productivity is not good. Agricultural practices are not good. So one would not expect them to be able to pay for a lot of rural labor, and plus a lot of government social intervention in terms of schemes like the Rural Employment Guarantee Scheme, which gives people a relatively easy option to earn a living or earn just enough to fill their stomachs, rather than slogging it out on the fields. So there is a bit of a shortage of labor. Labor would prefer to go to greener options like the manufacturing sector. So all that is good, as the report suggests, but where I disagree, or where I say the report hasn't gone all the way, is the much bigger question that is the economy generating enough jobs? There may be people coming out from near starvation to semi-starvation, or from being, completely without money to be managing a malnourished or semi-nourished existence.
Let me throw in some numbers here which the report has put out. It says that between 2000 and 2005, which is essentially the NDA regime, the pace of annual job creation was about 7.5 million, and these are non-agriculture jobs that we're talking about. The report goes on to argue that even in the period that followed, which is 2005 till 12, the pace continued to be the same, that over 52 million jobs were added over 7 years. You divide that. So again, the same pace, 7.5 million jobs per annum. But most of these jobs were being created in the non-agriculture sector. How would you, interpret this data?
See, for a long time now, India's agricultural growth has lagged behind economic growth, overall economic growth. So the services sector, the manufacturing sector has historically for decade after decade grown faster.
Barring, I think, the last couple of years where the trend actually reversed, because we saw agriculture doing better, whereas manufacturing was going into a complete slump.
Yeah, manufacturing had its ups and downs last couple of years, yes, but it's not that factories have closed down and people have sacked workers.
Sure.
So again, this is a debate about last 2 years and one sector relative to the other. The broader point is that job creation in India is not enough, and you need a heavy duty intervention to make sure there's a lot more manufacturing sector growth, because and it has to be in manufacturing. Services can generate jobs in Bangalore and Hyderabad and Delhi and Mumbai, etc. But for the rest of India, you need to have manufacturing hubs coming up, and manufacturing jobs have to be much faster.
Sure.
To that extent, this trend is in the right direction, but it's at a very small scale.
So to quickly wrap up the conversation, if we link this to the pattern of wage growth, one fact which is very clear is that there is more prosperity in rural India today than, let's say, a decade ago. Now, one can argue whether that's because of Manrega, whether that's because of other social programs. But is this trend a lasting trend, or do you think it's more based on quote-unquote dole-outs, or is there some real economic sustenance to this trend of prosperity, rural prosperity?
I think there is some sustenance, although it is propped up by certain doles. If you look at another trend which is very important for rural India, and that is the support price which the government agencies offer to crops. Now, there's no doubt that these 10 years, the support prices have gone up enormously.
Yes.
And to some extent, and some ministers have actually argued this, that yes, inflation is rising, but the flip side is that it is because we are giving more to the farmer. And it's not easy for any subsequent government to reverse this trend. Once you've got them used to a certain level of prices. It is such that at times Indian wheat cannot compete with wheat grown in, say, Canada, USA and Russia. It's partly because they have different kind of farming system. It's much more mechanized and a much larger holding than India. But at the same time, Indian farmers have been getting better prices, and to that extent it is going to be sustainable.
Sure.
Because nobody can say that this year's the procurement price is going to be less than last year.
Nobody reverses an
Yeah.
MSP which is
Yeah.
prevailing. All right.
Yeah.
Okay, we'll take a very quick break on that note. When we come back, a very interesting global debate that's raging on. Should Western central banks think about emerging markets like India when they set their home policy? Back in a moment. Welcome back to Policy Watch. Should global central banks, particularly those of major economies like the US, take the world economy into account while setting their domestic policy? It's a debate that's raging on the international policy horizon, and one that's been triggered by none other than RBI Governor Raghuram Rajan. Reiterating his views at the spring meeting of the International Monetary Fund and the World Bank, Rajan has asserted that the US Fed has not paid enough attention to the impact of its bond buying program and then its gradual withdrawal on emerging markets, a charge which has been vehemently refuted by former US Fed Chief Ben Bernanke, who was in India earlier this week. Bernanke said, and I quote, "Emerging economies are better off when investor countries are growing quickly. An unconventional monetary policy was necessary to keep the US economy growing and effective. In that respect, it's in everyone's interest to have the US economy growing faster," unquote. Now, while views and counter-views continue on this burning issue, one common ground that Rajan and Bernanke do seem to have found is the concept of inflation targeting. The former Fed chief asserted that monetary policy benefits from clarity and transparency, and it helps to let people know what the central bank is trying to achieve by setting a target. And of course, we know that our own central bank here, the RBI, is toying with the idea of defining a specific set target for inflation. Let's take this up. The first part of this debate first, Himangshu, a very interesting one. He's a man who doesn't mince his words, Dr. Raghuram Rajan. He is known to speak his mind, and he has been making this point at several international forums for several weeks now, in fact, over months now. What do you make of this interesting policy debate that's broken out?
See, all this is happening at a background of very unusual set of policies being followed the world over. You had severe economic gloom and doom in the West for a few years, and as a result, the US economy, for its own interest, has taken a particular monetary decision that they were buying bonds to the extent of $80 billion a month till the end of last year. This was to support their own economy. The flip side of that was that this was releasing a lot of liquidity, and a lot of the dollars were flowing to the emerging markets. Mm-hmm. So as soon as they said, look, we're going to change this, our economic growth is looking better, this disrupts the currencies of emerging markets, and particularly the weaker countries or countries where the macroeconomic numbers are not good, like India's were a year ago.
Where we touched 68, almost 69 to the dollar.
And people were already talking of it'll cross 70, it'll cross 80, it can do anything. So these are very, very disruptive things in the global economy in an interconnected world where dollar is a kind of an international currency, and most countries have lots of the reserves in dollars. So there is concern, and one of the views is that these countries, companies in these countries also, the most developed, the Western countries, US, EU countries, they are looking to China and India for the demands of their own goods and services. So it's kind of symbiotic that the Western countries should not do something which gives shock treatment and rattles the economy here. Because if rupee goes out of control, Indian economy is in tatters. It is, emerging markets have also been engines of global growth for a long time, until very recently. So Rajan does have a point. I mean, he's simply saying that there should be some coordination. You let us know what you're up to. Give the emerging markets time to react. Like he says, first time when the Fed suddenly said this, Indian rupee went out of control. This time India is much better prepared. They've controlled their deficits, they've controlled their, the foreign exchange reserves are better. So India is better prepared. So,
well, that seems to be the counter that a lot of the Western economies and economists are putting forward, that if your economy has structural problems and therefore there is a flight of capital in times of turmoil, then how can you hold a Western country accountable for that?
Well, that is a strong point, no doubt. But I think Rajan is not saying that rupee fell because of a particular country. There may be structural economy. The basic argument in favor of coordination is that don't give this sudden shock treatments. When you have a very unusual monetary policy in a globalized world, then there should be a sense of responsibility when you make changes. So it's a limited point that give the other countries opportunity to adjust, anticipate, and take measures to absorb these things. It's not good for anybody if any major emerging economy's currency slips 20-30% in a matter of few weeks. But the counterpoint is well taken that your own economy, your own house should be in order.
Well, looking at the way things stand right now, and we keep getting mixed signals again from the US Federal Reserve, whether they will keep tapering off their stimulus, keep winding it away, or whether it will be more gradual, etc. Do you think India right now is better placed? And we discussed some economic data points earlier in the show. Are we better placed to weather a change in US policy today?
We're certainly much better placed, compared to the time when rupee was almost on a free fall. There have been a pretty creditable effort by the government, particularly in the run-up to the elections when nobody expected the government to act that responsibly. So India is better prepared. Our Reserve Bank has got a lot of respect and credibility internationally, partly because the governor himself is
very well known in the international audience.
Yeah, he's got very strong Western stamps of quality from IMF and these foreign universities, etc. And some of the things he's done is what markets really appreciate. He's been very transparent. He's given a direction that he wants inflation in this direction. He was going to look at consumer price inflation. So he is in a sense practicing what he's preaching. He's himself been very transparent. If you remember before him, each time there was a interest rate increase, there used to be hue and cry. This fellow made it pretty clear, this is the direction, and he's increased interest rate
and
thrice,
everybody's been applauding him, saying yes, he's looking at price stability. It's fascinating, the market's reaction to all the hikes.
That's because markets were given a direction that this is where I want to go, and therefore these hikes were anticipated.
Which brings me then to the final point of so-called inflation targeting. Now we know that there is this RBI panel report, the Urjit Patel report, which is talking about setting a long-term target of 4%. Mr. Ben Bernanke seems to think that's a great idea. A lot of foreign economies follow this. But will this work in the Indian context?
Well, with sound economic policies, it certainly can work. I mean, India has seen phases of 2% inflation also, and not very long ago, maybe a decade ago. And somehow in India we are used to high inflation. So many people say 5 or 6% wholesale is quite good. Actually, it's not. World over, you don't, especially in good economies, you don't see more than low single-digit inflation. So 4% I think is a very reasonable target, which is achievable. If you have a lot of investment and good policies with the new government. One of the problems in inflation is the supply side management. So if you can do something about agricultural productivity, now whether you do it through GM crops, which is a very controversial issue, whether you do it through some sustained efforts in irrigation and seed supply or whatever, because that's a way where farmers can earn much more without increasing the prices, if they can just increase their produce. So if these things are done, 4% is very achievable with good sound macroeconomic numbers, investments going on strong, supply side managed, and globally this is going to be applauded.
Well, let's see how Mint Street and North Block communicate once the new powers are in place in New Delhi. Interesting times ahead, Himangshu. As always, thank you very much for taking out the time and being with us today. Well, that's it on this edition of Policy Watch. Thank you for joining in.